It's been the worst day for the United States that we saw on Thursday, which is the bond market where higher than expected inflation has triggered a surge in the yields, viewers. The 30-year yield is up 19 basis points, the 10-year up 14 basis points, and yields have risen 5x to 4.7% from 0.84% in 3 years. Neelkanth, now all of this is bond data, and not every viewer of ours will perhaps fully appreciate what is happening. Please decode it for our viewers. What is really happening in the United States, and why are bond yields behaving in the fashion they are?
Yeah, no, I think this is the most important question for anyone in the financial market globally, because the yield on the 10-year government bond of the US is the risk-free rate, the long-term risk-free rate for the rest of the world. And the fact that yields are now meaningfully up from what we and the markets were used to in the prior decade is something that is very important, and it's worth understanding. So the first thing is that the policy preference for the US has inverted from a loose monetary, tight fiscal, so basically lower interest rates, but you try to bring down your fiscal deficit, which was adopted after the financial crisis in 2009, to loose fiscal and tight monetary stance that we are seeing right now. So they've been raising interest rates, but the fiscal deficit is not being brought down as much as it should be. Now, so therefore, when we think about interest rates, the muscle memory that most people have is that the interest rates will go down to the level that they were used to. That if inflation starts to normalize, the 10-year government bond yield in the US will also fall back to the 2.5 handle. I don't think that's going to happen. And the reason is that the increase, so the band was 2.5% between 2010 and 2020. It has now gone up to in the 4.5% range. And of that about 200 basis points, 2% point increase, only about 30-40 basis points is the implied increase in inflation expectations. So even if inflation was to normalize to say 2%, 2.5% in say year or so, even then yields will not come down significantly. Why have yields will they not come down? Because the demand supply for US government bonds has changed very meaningfully. See, for a long time, the price insensitive buyer of US government bonds, which is the central banks, right? So central banks like, say, PBOC, the People's Bank of China, Bank of Japan, Reserve Bank of India, all of these central banks, when they bought US government bonds, they were buying them for liquidity, that you wanted to show that you had reserves in case the country's currency came under attack. You would have assets that you could sell very easily. And the US government bond is one of the most liquid assets in the world. Now, the problem is that incrementally, some of these central banks are not buying US government bonds, but the supply of those bonds has gone up substantially. So as the private players start coming in, they are much more price sensitive. So as they start worrying about the US fiscal deficit, the change in stance, which is that they're tightening the monetary conditions and they're relaxing the fiscal conditions. What this has meant is that the supply of bonds has gone up and the demand for bonds has not, and therefore the prices fall, and which means that the yields start going up.
If you like the video, do like, comment, share and subscribe.